basis. Based on that, we can have three approaches of how we can determine the working capital. The first one is the industry norm, economic modeling, and the strategic choice approach. Now, industry norm, as we know that every company belongs to a particular industry, and whatever has been the is the practice in the industry, the company more or less fits into that particular practice, knowingly or unknowingly, by choice or may not be by choice. Now, the majority of the institutes or majority of the units constituting a particular industry, if they adopt a certain practice, the other units are going to follow suit. For example, now if I'm dealing with a industry where the credit norm, the acceptable credit norm is, let us say, 45 days. Now, if I am operating in that kind of an industry, and I decide that no, I'm not going to give a 45-day credit, rather I'm going to provide a 30-day credit. It may not be possible because everybody else in the industry is providing 45-day credit. So if I reduce my credit period to 30 days, I'm going to lose my customer base or my clients to my competitor. And no organization wants to lose out on the market share. So even if I would not want to grant a 45-day credit, but I would be forced to do that because the other participants in the industry, they are doing it, and it has been accepted in the industry that the industry will provide a 45-day. Even the client who comes into my business, he also has come with the expectation of a minimum 45-day credit. So even if I want to reduce my credit period, I would not be able to do it simply because this is the industry norm. So because everybody else is following it, it becomes a practice in the industry, and hence that is the approach that we follow while deciding industry norm. That if an industry is following a certain norm of having certain number of days of working capital in hand, every other firm also does that. This is a very easy thing to follow, but there are obvious pitfalls of this particular game. Now, what are the pitfalls? The pitfalls could be, for example, it is not very easy to classify the units into a particular industry. For example, if I'm talking about let us say, container. Now, the container industry, I'm talking about utensils, basically containers, utensils. So, if I'm talking about utensils as an industry, the steel container, a glass container, everything will belong to the container. But then, whether are they part of the steel industry or are they part of a glass industry? So it is not very easy to categorize. The goods on the basis of there is no. There is no strict classification into category. It is not very easy, and especially it is not easy when the farm is a multi-product farm. So, for example, if we can talk about Hindustan Unilever or ITC, which have multiple product, it is very difficult to categorize them into a particular kind of industry. Now, if you are producing one good, it is quite easy to categorize. But then multiple goods, it is not that easy to categorize. Similarly, deciding an average to represent a particular industry is also very difficult. What should be the industry norm for a credit standard, whether it should be 45 days or 90 days or 30 days? It's very difficult to decide because somebody else is following, the industry leader has been following, everybody else is following the industry leader, and it has become a norm. It may not be the right approach. Simply because everybody else is doing it, may not be a right approach. The averages again have no meaning to many farms since the nature of the farms differ. For example, your volume of operation requires a 2 month of raw material, but my volume of operation might not require a 2 month of raw material. It might require a 15-day or 10-day of raw material. So the averages could be, it could be fatal for some of the organizations following the industry norm on the average. It also results in various kinds of imitative behavior, and it kills the innovation. For example, if I can devise a way of to manage with 15 days of raw material, I need not have 1.5 months of raw material excess, because industry practice is to have 2 months of raw material. I need not do that. If I can devise a way how I can reduce my raw material holding, then probably I can innovate, but following the law of average or the industry norm will kill that innovativeness. And this kind of a practice give rise to herd mentality, uh, where we have very very limited scope for excellence. We have very limited scope for doing something new. So this could be an obvious problem with the industry norm. Then we have the economic modeling approach. In the economic modeling approach, what we see is that the optimum, one of the modeling approach that we have seen is the EOQ model. Now, in an EOQ model, the optimum investment, we talk about what should be the economic order quantity. I'm talking about the in inventory management technique. So, the optimum amount of investment in an inventory is decided through this EOQ model. Now, what this model talks about, this is a very, very important concept and quite popular, how we place orders for purchase of raw materials. Now, the EOQ is given by a very simple equation, that is 2AO by C square root. Now, what am I showing? Obviously, my left hand side is the EOQ, and 2AO by C square root. Now, what is A? A is my annual usage of material, O is my ordering cost per order, and C is my carrying cost per unit. Now, if I put these, plug these values of A, O, and C into this equation, and I get a certain quantity as my, and this we have seen under ordinary circumstances, EOQ is a fairly good model for management of inventory. Similarly, the economic modeling approach, in the economic modeling approach of managing cash, the EOQ model has been borrowed by William J. Baumol. We call this a Baumol model of cash management. He has borrowed the concept of inventory management to deal with how much of cash to be kept in hand, to be held by the enterprise. Now, he has tried to replicate the EOQ model, and he has changed slightly the notations of this model. So he says the C star is equal to 2, capital C star is equal to 2 small c into T divided by K square root. This model is exactly the same as the EOQ model. Now, as for this model, the optimum level of cash, which is determined by the C star on the left hand side, is decided by the carrying cost and the carrying cost and the holding cost of cash, and obviously the cost of converting the marketable security into cash and vice versa. Where again here I'm showing T as my annual demand for cash, small c as a transaction cost per transaction, and K is my interest rate. So this model has been successfully applied for management of cash by Baumol, and it goes by the name of Baumol model of cash management. The third kind of economic modeling approach has been by Robert M. Solsky. Now, the decision to sell a particular account, I mean, when we talk about accounts receivable, whether we should grant credit to a particular customer or not, has been decided by this particular formula, where M minus B plus T underscore T subscript I plus C by O, it is greater than, if it is greater than 0, then we grant the credit. If it is not greater than 0, then we don't grant the credit. Now, what is M? M is my profit margin. B is the probability that the credit sale, if I undertake that, it might become a bad debt. I is the interest rate prevailing at time T. So it is whatever is the time, the interest rate prevailing then. Then you have the C is the cost per order of selling and credit as an implicit function of risk, and O is the order size. So if this, if we plug in the various values of M, B, I, and C and O, and the values come out to be greater than 0, then I grant credit to the client. If it is less than 0, then I don't grant him credit. So this has been extensively also used for managing the receivables. Apart from these two models of industry norm and the strategic choice approach, we have also the industry norm and the economic modeling approach. We also have a approach called the strategic choice approach. Now, in the strategic choice approach, this is, as I said, as is where is basis. That is, the strategic choice approach recognizes that every business has unique problems. There are variations in business practices, and that every business has the problems which are unique to the business. And the problem that I am encountering in unit A might not be equivalent to the problem that I am encountering the unit B. So maybe the industries are different. The economic modeling might not work for A and B as well. So what we have to do is we have to find out solutions for that particular problem in that particular unit. So this particular approach goes by the name of the strategic choice. Now, what is the spirit behind this approach? It is that we prepare the each unit of the business to face challenges of competition and take a strategic position in the market. Now, here we lay emphasis on the individual behavior of the SBU or the strategic business unit of a organization. The emphasis is given on how the SBU is dealing with unique problems and applying the local methods to solve that particular problem. Now, the strategic choice approach also presupposes that a highly competitive environment and willingness of management is there, because unless the management takes risks, because we're devising unique solutions, unique strategies for the problems. Some it might work, sometimes it might not work sometimes. So the management should be willing to take that kind of a risk to become innovative in the choice of the solution. So if the management is not willing, then this strategic choices approach may not be applicable. And this also needs a competitive environment. Now, to be successful, this again depends on the ability of the management, how realistic goals they are setting, and what kind of strategies the management is able to devise so as to address each of the problem. Because see, any kind of wrong strategic choice will definitely lead the farm into trouble. So after going through these three approaches, now we'll talk about what are the various factors that affect the working capital. Now, the first thing, we have in the first module itself, unit itself, we have discussed the role of inflation in affecting the working capital. So purposefully, we have not, to avoid duplicity of the discussion on inflation, I have not included the inflation here, but you can put inflation as a major factor influencing the working capital while writing for your exams maybe. We'll talk about other factors excluding the inflation part. Now, the first factor that affects the working capital is the nature of business. Now, if I am in a manufacturing firm vis-a-vis a service firm or a banking firm, then the working capital requirement will be changing. If I am in a manufacturing firm, I'll have all kinds of current asset requirement. I'll have work in process, I'll have raw material, I'll have finished good, I'll have obviously debtors. So all these things will be required, and depending on the scale of my business, also that will be changing. Similarly, if I'm talking about a service firm, the concept of this raw material, work in process, and finished good will take a different form. For a banking industry or a finance industry, this could be a different form. So, as we can see, the nature of business also decide what kind of current asset I'm going to hold, what will be the quantity of the current asset I'm holding. So, the nature of business definitely decides the working capital requirement. Next one is what kind of a risk the management, what kind of attitude the management possesses towards the risk. Now, say for example, I am very comfortable. Suppose your management is very comfortable that they want to hold a very high level of current asset. Now, when I'm talking about high level of current asset, I mean the current asset minus current liability is the net working capital. So, if you want to hold a very, very high level of net working capital, how can you do it? By increasing the current asset. So, you will increase the level of current asset, so your net working capital will grow. Now, what is the outcome of a very high net working capital? The outcome is that the um, you will be able to meet the current liabilities as and when they arise. So you don't. So what will happen is you can relax, you can sit easily, and because you have a very excessive current asset over current liability, you can relax. But management who wants to increase, but that will also result in low profitability. But if you want to increase the profitability, then you have to deal with this kind of a thing. For example, you reduce the current asset. So the manager will always be on his toes to arrange for funds whenever a bill arises. So this kind of an attitude, like risk-taking attitude, where you are confident that you can manage with less amount of working capital or current asset. So it will also ensure high profitability. Now, see, if you are holding high current assets, your risk will be very low, but again, at the same time, your profitability will also be very low. Similarly, if you are going for low current asset, you will have a very high risk because there might be a scenario where you cannot arrange for funds and you have to dishonor some of the claims that have been made against you because you don't have the fund, you could not arrange for the fund. So this kind of a risk will always be there. But also we have to keep it in mind that the profitability will be very high for this kind of a farm. So the if the management's attitude towards risk is if the management wants to go for high risk taking, then they will have low amount of working capital. If the management attitude is to take not to take risk, they will manage with a high amount of working capital. Next in point is your growth and expansion of business. It is without any explanation now. It should be clear to you that when a farm is growing, it has to produce more. It has to sell more. When a farm is expanding, it goes into different business activities. So in both of these cases, we have to produce. In one case, you have to produce the same quantity in more same unit in more quantities. The second case, we have to produce a variety of items. Now, in both the cases, your working capital requirement will grow. In the first case, if the working capital requirement of the same item will grow, the second case, the working capital requirement for the different items, it will grow. The production policy, we see certain cases where there is seasonal fluctuation of the product in question. Now, the company can follow two kinds of production policies. One, suppose a product, if it is following up and down cycle during the year, the company or the management can decide that the production will happen at a steady pace so that the finished goods will be built up in the off season and the finished good will be used up during the peak season. Or the management may decide that the production policy is going to be stepping up in the peak season and stepping down in the off season. So, depending on this kind of production policies, the working capital requirement will also vary from farm to farm. Though both, maybe farm A and farm B, both of the farms have seasonal item, but if one farm follows step up, step down kind of a production, the other farm follows steady production throughout the year, the working capital requirement for both these farms will be different, even if the product is same, even if the market share is the same. Next in question is your business cycle. When I'm talking about business cycle, I basically mean the economic state of affairs of the country. For example, we know the economy goes in a four-phase cycle, like expansion, then peak, then recession, and trough. Now, in what stage of the business cycle the economy is in, that will decide what will the impact. If the economy is in expansion, then obviously all the farms will be producing more and they will be selling more. So the working capital requirement will be very high in expansion. But in case of a contraction, it might not be so. In case of a contraction, the working capital requirement will gradually slow down, will be less and less because there is a gradual slowdown of the activities of the commercial activities. The terms of purchase and sale, the what kind, am I purchasing on cash or am I purchasing on credit? And what kind of a credit am I getting? Similar kind things with the sale. Am I selling on sales or am I selling on credit? And what kind of a credit I'm granting? What is the credit I'm getting from my supplier? What is the credit I'm granting to my customers? That will decide the working capital requirement. Now see, if you are granting a credit of 2 months and you want to extend the credit period to 3 months, your working capital requirement will go up, because now you're giving more credit, so you're trading more bills receivables, so your working capital will grow. Whereas suppose your supplier of material, he wants to decrease the credit. Now if suppose he increases the credit given to you, so you were earlier getting 1 month credit, now you are getting 2 month credit, so that will have an impact of reducing your working capital requirement. So the terms, how you are purchasing and selling, the credit terms also has a great impact on your working capital requirement. Last and the most important one, I guess, that is the operating cycle. Now, what is an operating cycle? We'll be discussing in details right now about the operating cycle. Now, the operating cycle is the cycle where I start with a cash and I go through the entire production process, the selling process, the collection process, and then I come back to the cash. Now, the operating cycle shows the entire duration of turnover of the current assets. Now, the point is, suppose my operating cycle was traditionally 80 days. Now, I'm seeing that the operating cycle is gradually stretching, and it is going towards a 100-day period now. So, what will happen is, if there is a stretching of the operating cycle, the working capital will be more and more blocked in the operating cycle. So there will be increased requirement of operating cycle. Whereas if you can control your operating cycle, and you reduce the number of days of the operating cycle, then you can reduce the working capital requirement. Now, as I said, we'll be discussing in details regarding the operating cycle. Now, what is an operating cycle? It is the time duration that we require to convert the sales after the conversion of the resources into inventories and into cash. The operating cycle of a typical manufacturing farm involves 3 phases. The acquisition of raw material of the resources phase, which includes raw material, labor, power, fuel, etc. So we acquire these resources. Then we we enter into the production process where we manufacture the product, which includes the conversion of raw material into work in process and subsequently into finished good. Then we have, once the finished good is ready, then we have sale of the product, either for cash or for credit. If it is for cash, the operating cycle completes there. If it is for credit, then the operating cycle further continues until the accounts receivable is collected. And the length of an operating cycle is the sum of these two things. That is the inventory. We talk about a gross operating cycle. So this is the gross operating cycle where the cycle is inventory conversion period plus the debtors or the receivables conversion period. Inventory conversion period is the period from procurement of raw material to the point of sale of the finished good, and debtors conversion period is the period from the point of sale to the point of collection. Now this is what I have shown in this particular graph, where you see the inventory conversion period plus the receivable conversion period. So the entire length is your gross operating cycle. Now, from the gross operating cycle, if I deduct the payable cycle, then I reach at the net operating cycle. Now, the gross operating cycle can be determined by, as I said, inventory conversion period plus the debtors conversion period. And how do we decide the inventory conversion period? Inventory conversion period consists of 3 phases: raw material converting to work in process converting to finished good, and finished good production of finished good of the finished good. So three stages. So ICP, inventory conversion period, is equal to raw material conversion period, RMCP, plus work in process conversion period, that is WIPCP, plus the finished good conversion period, that is the finished good conversion period. Now, the how do we compute the debtors conversion period? The debtors conversion period is um, the debtors divided by the credit sales by divided by 360. So that will give you the number of days in which the debtors could be converted into your cash. Then once we add up this inventory conversion period plus debtors conversion period, we get a gross operating cycle. From the gross operating cycle, as I said, you have to deduct the deferral period or the creditor conversion period, which we compute like this. The creditors deferral period is creditors divided by credit purchases, daily credit purchase. So I am doing a divided by 360. So we get the creditor deferral period, and if we do that, the deduct that from the gross operating cycle, we get a net operating cycle. Now, based on this net operating cycle, we compute the working capital calculation. So it is also could also be referred to as a cash conversion cycle. So what I've done is I have got a small case study here for you, where we can discuss the entire process of calculation of this working capital. Now see, the case goes like this. The ABC company, it plans to achieve annual sales of 1 lakh units for the year 2020. The following is the cost structure of the company as per the previous figure. So I have taken from the previous data. So it has been seen that the material is 50% of the of the selling price. The material cost is 50% of the selling price. The labor is 20% of the selling price, and the overhead is 10% of the selling price. So you see there is a 80%. The total is 50 plus 20 plus 10. That is the 80%. That means of the selling price, 80% is the cost, and obviously the remaining 20% is my profit. Now, what are the other additional things that I have taken here? The raw material that are expected to remain in store for an average period of 1 month. So raw material stays in store for 1 month. So we procure raw material, and before it enters the production process, it stays in the store for about a month. So finished good, and why we keep these things in store? Because we never know if we require more amount of raw material in a day, or there could be a shortage of raw material in a day. I place an order and I don't receive the order, so I keep a safety stock in hand for 1 month. The finished goods, they stay in the warehouse for 2 months on an average before they are sold. The unit of production, each unit of production will be in the process for 1 month. That means the work in process continues that means the entire production process continues for 1 month. We allow credit to the customers. Our clients were allowing credit of 2 months, and our supplier allows a credit of 1 month. So credit allowed by suppliers of raw material is 1 month, and debtors are allowed credit of 2 months from the date of sale of goods. And obviously, as I said, the rupees 9 is my selling price, of which 50% is material, 20% is labor, 10% is overhead, and the remaining figure is our profit. Now, the additional thing that is given is production and sales follow a consistent trend. This is the assumption we automatically make. We are not talking about seasonal product. We are talking about production and sales happening at a constant pace. Otherwise, it is difficult to compute the working capital requirement. And you are required now to compute the working capital required to finance this 1 lakh units of production for the said year. Now, how do we go about it? Now, see, I'll show you a format how the working capital is done. Now, the format is like this. This is the statement of a working capital required, where we have what is, first we list out the current assets. Under current assets, we have the raw material, the work in process, the finished good, the debtors. So we add up all these things. So we get the total current asset or the gross working capital. Then from that, we deduct the current liability. So we under current liability, we have the creditors. So various kinds of creditor. So we deduct that. Now we get the net working capital. So this is based on the operating cycle because I am going to use the days. So from the operating cycle, these days I have derived the 2 month, the 1 month, the whatever days. So these are derived from the operating cycle calculation. Now see, the problem said that the raw material will stay in the warehouse for about 1 month. So what is my investment in the raw material for that 1 month in that case? So what I'll do is my annual units of, because I'm planning for 1 lakh units of production. So 1 lakh I'll put here, and the cost of my the unit cost. What is my unit cost? My unit selling price is 9 and the cost is 50% of that. So what I've done is I put 9 here. I put the 50%, which I've written as 50 by 100 here. And since the raw material stays in the inventory for 1 month, so it is average I'm taking 1 month. So this is, since this is the annual, I have to convert it into a monthly. So what I'm doing is doing a divided by 12. I could have done it like this, 1 lakh divided by 12. So that is my monthly planning. And I could have done 50% of 9, that is 4.5 rupees that I put here. But to be more lucid, I'm showing you each one independently. This is my annual, 1 lakh is my annual requirement. 9 is the price, selling price. 50% is the material price. 50% of 9 is my material price. And on an average, I'm keeping the raw material for 1 month. So that is, I'm doing 1 divided by 12 because my planning is for a month. I'm doing for a month. So the total works out to 37,500 here. Similarly, in the case study, it is written that the work in process stays in the inventory for a month. So what is work in process? As we saw here, the work in process it means that the entire material is consumed, the labor is also used, the overall is also used. So what I'm doing is the total of 80% I'm putting here in the work in process, because some of the books, some of the authors do what is they take 50% of the cost. For example, they will compute the entire cost here like 60,000, and then they will take 50% of it by assuming that only 50% of my work in process is completed. Because see, when we're talking about operating cycle, various stages of productions are there. So some good could be 10% complete, some could be 80% complete, some could be 60% complete. So what we assume is we make an assumption that the work in process is 50% complete. So in that case, some authors take a 50% value of that. So in this case, we have taken the full value because we assume that the full amount is blocked. So again, the annual units requirement 1 lakh into the cost of the selling price of the unit, and 80% of that, plus since it is a 1 month, I am doing 1 by 12. So that is 60,000. Now we talk about the finished good. In the finished good inventory, it is staying for 2 months. So again, I'm repeating the calculation like 1 lakh, my annual units, into 9 is the selling price, 80%. Again, ideally I should have taken the cost of sales. But because every other data, no other data is given here, I'm assuming the cost of production to be the cost of sales. That footnote you have to give here. That since there is no other data regarding the selling and admin expenses, so cost of sales is not calculated. We have used the cost of production to compute the finished good inventory. So this is the calculation. Because it is for 2 months, you will do 2 by 12. So it is 1 lakh 20. Again, debtors. You are allowing a 2-month credit period to the debtors. So what you will do is the annual units into the price of the unit. And again, the month 2 by 12. Because in a year you have 12 months, so 2 by 12. Interestingly, this is 100 by 100 because when I made a sale, even my profit is also blocked. So earlier what we were doing is of 9 rupee only 80%, that is 7 rupee 20 paisa is blocked in finished good. We're assuming in work in process only 7 rupee 20 paisa is blocked. In raw material, 4 rupee 50 paisa is blocked. But in debtors, I'm assuming that the entire 9 rupees blocked, because even until and unless my sales are realized, I'll not be able to get my profit as well. So my profit is also blocked. So what will happen is sometimes banks actually don't finance the profit; they finance the cost of your production. So you might do that, but the banks will probably deduct this amount, make it 80% and recalculate. So because they will not finance your profits for sure, they will finance your level of activity. But if you're saying that my profit is also blocked, the banks are not supposed to finance that part of the investment. So that is why, but in calculation we have shown it to be 100% of my cost is blocked. So this is the total is 3,67,500. So this is how the total current asset is computed. One additional tip here. In this particular case, all these days are given, I mean the periods are given in months, 1 month, 2 months, like that. In some of the cases, the days could be written as, the period could be given in days, like 15 days, 20 days, or could be given in weeks, like 4 weeks, 5 weeks, 11 weeks, 12 weeks, like that. It could be given like that. So students are advised to, if it is given in month, you do it in a monthly format, like 1 by 12. If it is given in, if a particular thing, like, let us say the work in process were given in days, let us say 15 days, what would you have done? You would have done in as per the days convention, that is the 15 days divided by 360 days. Now see, you have to make a footnote here that the year has 360 working days. 5 days, we're assuming that the production doesn't happen on the 5 days due to maybe scheduled maintenance, breakdown maintenance, holidays, and so. So we assume that there are 360 days of production in a particular year. So what you will do is 15 days divided by 360 you will do. Similarly, if you have weeks, 4 weeks, then what will you do? You will assume that a week has, a particular year has 52 weeks. We'll make a footnote that we are assuming that a year has 52 weeks. So it will be, suppose finished good would have been 4 weeks. What would you have done? You have not done everything else, but in case of days, you would have written 4 by 52. So, and the rest of the things would be as it is. Instead of 2 by 12, you would have written 8 by 52. 1 month is 4 months, 4 weeks. So 8 by 52 you would have done. So this is an additional tip of how to go about the calculation. Now we have got the gross working capital. Now we'll talk about the net working capital. Now how do we get the net working capital? I have to deduct the creditors. Now who are my creditors? Here I am assuming that the creditor is my supplier of raw material. In fact, my creditor also, you can say labor is also a creditor, because that calculation has not been done here in this particular case study. The creditor is also the 20% labor and the 10% overhead. They are also the, you have not paid that. Labor you have not paid, you pay at the end of the month. So that should have also been done here. So what you have done is only you are talking about the suppliers. So you take the suppliers as the creditors here. So what we have done is the 50 by 500. So the 50% cost of the total amount. So we have done it, and we have calculated the working capital required here. So this is how you compute the working capital requirement of the farm based on the working operating cycle. Now, as we know that the working capital, the commercial banks which are for granting the working capital of farms, there have been several committees to decide on the policy of how to advance the working capital loans. Now, the several committees around the 70s or the 60s, rather, there have been several committees that have been deciding on what kind of this thing, the working capital will be granted to the commercial organizations. Now, the various measures have been taken by the RBI to grant to talk about these things. So, what are the various measures that have been taken? The first step that was taken in 1965 was the introduction of a credit authorization scheme. Then formation of the Hygieia committee in 68, formation of Tandon committee, the most popular committee for granting, which talked about the MPBF, the maximum permissible bank finance. Then we have the Chore committee in 1979, because we still follow some of the Tandon committee norms, and we discuss in the Tandon committee here. The Tandon committee, for the first time, it made an attempt to actually prescribe the norms for holding the various current assets. The committee also, sent in advisories to commercial banks so that they can quantify the desirable level of net working capital and the maximum permissible bank finance. Obviously, the NPBF concept has been remodified, has been changed a little bit, and it is no more there. The NPBF is no more there. In its approach of this lending, the committee identified the reasonable level of current asset, what should be there, and this reasonableness is shown here. This also today, till date, it forms the calculation of the different methods, the various methods that we just talked about right now, and we will be talking probably in a short while now. The various methods, this is the standard we are using. Now, raw material, a month's consumption. We just saw in our case study that raw material for a month, work in process 1 month, finished goods month of cost of sales, receivable 1 month. These are what the Tandon committee prescribed and advised the banks that the financing should be done as per these particular guidelines. Now, as per these banking committee norms of working capital finance, now the norms represented the maximum level of inventories and receivables for each type of industry. It also laid down that holding of any other kind of asset is higher than the level fixed by the relative norm, the surplus would be treated as the excess, holding to be shed off. It has to be shed off by the organization because it is in excess of the banking committee norm. Now, it is also, it was not permitted that you will set off such excess against any other shortfall in the current assets. So there were several changes like that were introduced, but the basic philosophy of this banking committee norms have not been changed. Now, what are the present policy? No, the commercial banks, after the implementation of this phased liberalization since 1991, the RBI has decided to allow full operational freedom to the banks in case of assessment of working capital requirements of the borrowers. Now, the instructions relating to the MPBF have been withdrawn. The maximum permissible bank finance has been withdrawn. However, there is a revised system put in place for assessing the working capital limits, which has been evolved. Now, as per this, 3 methods, one of the following methods, there are 3 methods available now. We can follow any one of these methods for assessment of working capital. The commercial banks could follow any one of these methods. The more popular method of them is the turnover method. Then you have the eligible working capital limit method, which is more or less equivalent to the MPBF, the maximum permissible bank, more or less equivalent to that. Then you have the cash flow method or the cash budget method. Now we'll just have a look at each of these methods. Now, what does the turnover method say? Now, the turnover method says that the working capital requirement of all borrowers who enjoy the fund-based working capital limits up to rupees 2 crore from the banking system are being assessed on the basis of a minimum of 25% of their projected annual turnover. Of this 25%, the 5% should be brought by the way of promoters' contribution, and the remaining 20% is to be financed by the banks. Now, for example, if the projected sales turnover of a company, of organization is 1 lakh, then the working capital gap here would be, as we just discussed just now, is 25% of the turnover, that is 25,000. Now, of this 25,000, 5,000 is to be the margin money from the borrower, and the remaining 20,000 could be financed by the bank. This is how the turnover method, it's a very simple method. This is how the turnover method goes. Now, however, the next method, which is, as I said, is almost equivalent to the eligible working capital limit method, almost equivalent to the MPBF. Now, what happens is, now the for the eligible working capital limit method, it's quite a bit different from the for the SSI and for the non-SSI. Now, if what we do here is, if the total working capital required by the borrower is 15,000, then we deduct the current liability excluding the bank borrowing. That is, in this case, in this particular case, it is 10,000. We call that the remaining thing as a working capital gap. That working capital gap works out to 40,000, and of which 25% from borrower through long-term sources, and the remaining bank finance would be 30,000. So the what happens is, the inventory management margin requirements will be 20% for in case of SSI borrowers, and 20 to 25% in case of non-SSI borrowers, depending on the stipulated current ratio of the firm. While the limits will be assessed and sanctioned on the basis of 25% of projected gross sales, less prescribed margin to be provided by the borrower, the actual release under the sanctioned limits had be on the basis of the drawing power of the organization. So this is regarding the eligible working capital method. Now the last method is your cash budget or the cash flow method. Under the cash flow method, what we do is, the working capital requirement of these borrowers who seek fund above 2,000 lakh, they have to be assessed by the cash budget method or the EWC method that we just discussed earlier, now as decided by the bank. Now, the corporate borrowers whose management of finance is cash budget driven, and the existing client of the bank who have a consistently good track record of fulfilling the specified norms, can opt for assessment under cash budget method. Now, how does this cash budget goes? Now, under cash budget, what we have is, we can, as we discussed another in the first class, I think, the concept of a cash budget. Now, the concept of a cash budget is that you first list out all the receipts, inflows, and you deduct all the outflows. So you have a balance figure which is either a surplus or a deficit for that particular period. Now, when we're talking about cash flows, we talk about the cash flows from business operations, in both inflows as well as outflows. We talk about the cash flows from the non-business operations, again all inflows and outflows. We talk about the cash flow from the capital accounts, also the cash flow from all the sundry items. Now, based on that, we compute the gap or the balance, and based on that, we talk about the finance to be availed. Now, I have given here a small case study for this balance method of this cash method. Now, I have shown for 3 months, May, June, and July, 3 months. Now, you have the opening balance of cash for each of these months. Then you have the estimated cash receipts from the debtors. Then any other cash receipt you can put it here. Then you have the various cash payments for that particular period. You have creditors, wages, manufacturing expenses. So these are your closing balances. Now this will be now. Suppose your minimum balance requirement is, suppose now closing balance for the month of May is, let us say, 13,750. Now, if your minimum cash requirement is 40,000 rupees or 50,000 rupees, now you are falling by a margin of that level. So you can apply for, when we are talking about assessment of bank finance, the cash gap between these we can talk about, that will be applied for a bank loan. So similarly, in each month you could have a deficit, you could have a balance based on the cash balance that is required to be maintained. And we talk about the cash gap in the business operations, the again the net cash gap. Okay, so the highest cash gap during the period under assessment is to be extended by the way of eligible working capital limit. Whatever is the highest gap is to be your working capital limit. Now, so based on the cash budget, we can always decide in which of the months the cash position of a farm is in the surplus position, in which of the months the cash position is in a deficit position. So the surplus is to be invested, the deficit is to be financed. But on any particular day, the cash gap, the total, the cash gap from the operations, that is to be your working capital limit. Um, so this is how the banking committees, the banks, these are the three methods how the banks can use for the assessment of working capital. Now, to sum up what we have done in this particular session, now your block one is, since it is over, we'll just sum up what we have done. Now we saw that the determination of adequate working capital for a business is very, very significant, because if you don't assess it properly, there might be a scenario where we can have an excess of working capital as well as the shortage of working capital. Now, both the scenarios are not desirable for a management, the excess of working capital as well as the shortfall of the working capital or the deficiency of the working capital. Now, what will happen if you have deficiency? We all understand what will be the problem, because we'll run out of cash to pay our bills. We'll run out of cash to, so this will, if you don't pay our bills on time, we'll lose credit worthiness. The shortage of cash, we cannot purchase raw materials, we cannot pay our labor. So there will be stoppage in the production activity, which will result in a huge amount of loss. So the shortage of cash or the deficiency in the working capital is dangerous. We all know that, and this is quite visible to our eyes. But if you talk about what will be the consequence of excess of working capital, too much of working capital, is the problem is that you will become very lax. The management will become very lax and very relaxed. That because they have too much of working capital, it is as good as, suppose you require 10,000 rupees in a month to survive, but you have 15,000 rupees available. So obviously you will not care about the cash, because you know you have excess cash. But if you require 10,000, only 10,000 rupees is available, then you will be prudent in management of your cash. So excess working capital leads to laxity of the management, and which can have a long-term impact on the growth of the farm. So it is not advisable to have, it is not advisable to have either excess or deficient working capital. So that is the reason why it is optimum importance that we should determine the working capital correctly. Now, the value maximization also implies that the optimum investment, that there should be optimum investment in all the assets, all the both current asset as well as the fixed asset. Now, what are the three approaches of investment in working capital? We just saw that the three approaches could be the industry norm approach, the modeling approach, where we talk about number crunching and modeling, and then the strategic choice approach, where we talk about individual strategies for individual units and individual problems. Now, we saw that the industry norms have been worked out, taking into account the nature of operation of the business, and each unit's requirements are assessed with respect to the industry benchmark. Now, the economic models, they are pressed into service to make certain projections of current asset like inventory, like cash, and whether to grant credit or not to grant credit. So we have used modeling for this thing. Now, under the strategic choice approach, the business firms were advised to follow their own unique problem and solution approach. So, because it cannot be a one solution fits all, because your unit's problem is peculiar, so you have to devise a particular solution to your particular problem. So, that is the strategic approach. Now, against these theoretical conditions, again we saw that it is the operating cycle which necessitates that the working capital should be available to the firms, and we also saw how the operating cycle is to be calculated, and then what is the impact of the operating cycle, the prolonging of the operating cycle, what is the impact, and shortening of the operating cycle, what is the impact. Now, based on this operating cycle, we also saw how the working capital is to be calculated. By first we computed the this gross working capital, and then we deducted this total current liability from the gross working capital. So we reached the figure of the net working capital. That is the capital that we normally apply for finances from the banks. Obviously, while banks are financing, they go by the cost method. Though we talk about the selling price method, the revenue, we talk about the entire price, the banks only go by the cost method, and they deduct the non-cash items involved in calculation of this working capital requirement. Now, when I talk about the non-cash items include the profit. The one thing we discussed, the profit is the first thing that is discussed, the non-cash item, and the second non-cash item that is there is the depreciation. So banks will always deduct these things, and they will go by the cost, absolutely cash cost, not the cost per se. They'll go by the cash cost of the unit of production. So banks go by that norm to finance the working capital. Now, we also saw that the various other factors that affect the working capital requirement, like nature and the growth rate and all those things out there, and the various banking committee and their norms, how the banking finance is to be granted, the advisory from the RBI. So basically, this unit gives you an idea regarding how to compute the working capital requirement in terms of quantify, and then also how to approach the bank to get a loan and get an idea regarding how much of loan is possible and what should be the margin provided by the owner of the business to get the finances. So with this, we come to the end of this block 1. Thank you.